In today's headlines, SoFi, the fintech company SoFi, rolls out brand new ETFs. And guess what, guys? They are free. Absolutely free. What do we think of that? And the Wall Street Journal reports recently, Target, the big bullseye. Target's got their bullseye set on Victoria's Secret. What does that mean to you? We'll have all that and more on today's Money in the Morning. Live from my mom's half-finished basement just outside Detroit, Michigan. I'm Saul-Sehy, Average Joe Money on Twitter. Welcome to the show where we take not just one, but two headlines ripped from the financial press. And not only do we read them like some podcasts do, no. We actually talk about them and what they might mean to your wallet. And as if that is not enough, then we take both of those topics and we roll them together into one thing we present at the end of the show that we call the big idea. Money in the Morning today is brought to you by Emperor Investments. Man, I love Emperor Investments. Investing in individual stocks to meet your goals. EmperorInvest.com/MITM. This episode of Money in the Morning is presented by Emperor Investments. Automated investing refined. Emperor offers 100% equity portfolios designed to earn dividends while you enjoy your life. For 6 months, 100% free. You're welcome. That's just because you're listening to us. 6 months, 100% free. Use our link, EmperorInvest.com/MITM. Good stuff there. We'll talk a little bit more later about Emperor Investments. All right. You've got places to go. We've got a show to make today. We're going to talk about everybody who's with us here live is talking about the fact that for the first time ever, Joe's going to be talking about bras today. And while we could make a bunch of jokes, we're not going to do that. We're going to seriously talk about competition in bra land. But first, we're going to talk about fee-free ETFs. That was hard to say. So let's get the party started.
Good morning. You supply the coffee. We'll bring the headlines. Here they come.
Doesn't that seem fair? Seems fair that you bring the coffee, we bring the headlines. I mean, that's like a give and take. If you really wanted to be cool, though, you could bring donuts because I'm all about the donuts. But bringing the coffee, that's good. Our first headline comes to us from Barron's, and it's written by Crystal Kim. Fintech startup SoFi to offer zero-fee ETFs, and then the kicker, with a catch. The piece says, free draws a crowd. At least the fintech startup SoFi seems to hope it will. The lender on Monday filed to launch exchange-traded funds with the low cost of zero. Don't be shocked, but there's a catch. The ETFs are only free under a waiver of annual fees. The backstory. Fidelity fired the last meaningful shot in the fee wars when it launched a pair of mutual fund indexes that charged nothing. That wasn't the killer move everyone thought it would be. Both funds raised billions quickly, but inflows of money have waned since the initial flashbang of the zero free news wore off, as Barry Ritholtz of Ritholtz Wealth Management pointed out last week. That hasn't stopped fund shops, big and small, from trying to draw in fresh dollars and new customers with uber low fees. It was only a matter of time until zero fees hit ETFs. The plot twist? SoFi, a new entrant to ETF land, on Monday filed paperwork to launch two growth-oriented ETFs, the SoFi 500 ETF and the SoFi Next 500 ETF under the tickers SFY and SFYX. These ETFs have a management fee of 0.19, but the fund's investment advisor will waive that fee until March 27th, 2020, according to the filing. Moving forward, SoFi's zero-fee move makes good marketing sense. The fintech just last week started offering brokerage services like Robinhood. It allows do-it-yourselfers to trade individual stocks and ETFs without transaction fees, and it even has a robo-service. So grabbing headlines with zero-free ETFs could bring customers for those other businesses. But remember the rules of ETF due diligence. Fund size, liquidity, and tenure matter. and should be prioritized over cost. Ignore the shock and awe of free funds and consider the value of what's already available. Broad market ETFs such as the iShares Core S&P 500 ETF, ticker symbol IVV, and ETFs that are similar to SoFi's offerings but are big, trade with tight spreads, keeping transaction costs low, and have track records. More than 90% of inflows to ETFs already go to funds that charge less than 0.2. To be sure, these ETFs could become the new hot kid on the block and attract enough assets to keep waiving fees or even make zero permanent. It's also possible that they don't attract much money and the zero fee offer will be a one-year wonder. What a place to leave that, huh? Not really sure what's going to happen next. But SoFi decides that they're going to have the next zero fee thing. So here's my take. I agree with the Barron's article. I think that when it comes to zero fee, you got to always think to yourself, what's the catch? And certainly SoFi wants you in their universe. And in this case, different than Fidelity, who's introduced these without any mention of fees going up right away. These guys are telling you there's a good chance that the fee might be going up in 2020. But the fee even after 2020 is low. So here's my problem. This, much like we saw with Fidelity's product, when Fidelity first offered fee-free stuff, everybody jumped in, and as Barry Ritholtz says, according to this piece, we've seen those inflows wane on the Fidelity products. Why? Because the people that are just interested in free all jumped in at the same time. Sure, you'll still have a steady inflow now of people that just want free stuff. But you know what's funny? I've got plenty of t-shirts I don't need. Somebody offers me a free t-shirt. I don't really like it anymore. I got some coasters at a hockey game this last week. Went to see the Detroit Red Wings lose. Kind of boring. The stadium, by the way, was beautiful. And the coasters were absolutely free. I'm going to give them away at game night. I don't need more coasters. So it ultimately comes down to, yeah, it's free. But the bigger question is, what is it? And what's funny is when you dig into these exchange-traded funds, these are funds that are trading based on proprietary algorithms. And they're not a straightforward 500 index fund. These actually are traded funds. And so then you have to wonder, what's the algorithm all about? They have no track record, zero track record. So it's free, but we don't really know what we're getting. Where if I just invest in IVV, let's say, I get the lowest cost available without it being free, and I know exactly what I have. So instead of going for free, getting all excited about free, and that's why they do it, right? So you get all excited about free. I would back up the train, and I'd say to myself instead, what's my end goal? What rate of return do I need to reach that end goal? And then, does this product fit? And where I come down on that isn't yes, and it isn't no. The fact that we have a proprietary algorithm at work and we don't know gives me the answer of, I don't know if it's going to work. There you have it. Free. So what? And the big question, by the way, overall with this whole thing, and I think this will be our takeaway for piece number one, for me, the takeaway is always this. And I like this when we talk to our fintech founders on the show. Every Friday on Stacking Benjamins, my other podcast, I talk about financial technology. One of my favorite questions always is, tell me exactly how you get paid. And it's funny because sometimes it's hidden stuff, right? We have a banking partner and your money goes into this bank account. We don't pay you much interest and we get some of the money from them. Like, okay, that's fine. I get it. And I actually feel more comfortable knowing that, right? Because I know how they get paid. Or we're going to charge you $1.50 or whatever it might be. Some places even have said, and if you've listened to that show, you know this already. They say, well, we're not making any money now. We're hoping to offer products and services that are premium ones in the future, but we're just getting our big mailing list first. Okay. If I know why they're getting paid. But nobody does anything for free. So the big takeaway, how do you get paid? SoFi plans to get paid either in 2020 or if they get enough people to market this stuff, like Barron's just said in this piece, maybe it's free for a longer period of time. I don't know. It's going to be interesting to see, though. Let's say hi to all of the people hanging out with us today on Facebook because we have a nice little crowd of people hanging out. We're recording this at a weird time. We got Kevin here. Katie's here. Hey, Katie. Kathy's here. We've got Mike here with us. He says, let's stack some Benjamins. I'm ready to go. And we've got a lot of discussion about our second headline that's coming up where we're going to talk about Victoria's Secret. So a lot of bra discussion, specifically the Seinfeld episode about the man's ear. And the bro, very, very funny stuff. But let's talk about these things. Katie says, my 5-year-old Emma wants to know if he can see us. Katie, to say yes. That'd be creepy, wouldn't it? That'd be, yes, I can see you. And stop doing that with your face. That'd be awesome. And Kimberly commenting on the Red Wings. But Kathy says, you get what you pay for? The question is, I don't know. This could be great stuff, Kathy. Just until we have a track record, we have no idea what we're paying for. That's the harder thing I have. A mystery bag. This might be the best thing ever, but we don't yet know. Good stuff there. Let's move on to the second piece, which comes to us from the Wall Street Journal. And this is what everybody hanging out with us in our live Facebook group has been waiting for. Yes, Joe talking about bras. Wall Street Journal reports, and this is written by, who wrote this piece? This is Khadija Safdar wrote this. And this is interesting because, I mean, when you think about bras, don't you think about Victoria's Secret? I mean, Victoria's Secret has made themselves synonymous with that world. It's the first thing I'm sure a lot of people think of when they think of undergarments, lingerie lines, but maybe not anymore. Target takes on Victoria's Secret. Target Corporation's launching a new line of lingerie and sleepwear, becoming the latest retail behemoth to challenge market leader Victoria's Secret. Victoria's Secret's long dominated the intimates market with images of supermodels and push-up bras listed at prices up to about $60. But a shift in customer preferences toward more natural looks and less structured garments, such as sports bras and bralettes, has made it easier for apparel retailers and online sellers to compete. Target next month will launch 3 brands to sell women's bras, underwear, and pajamas that it expects will hit more than $1 billion in sales in a year. Some of the sales will come from eliminating Gilligan and O'Malley, its existing brand for undergarments and sleepwear. Target said all the new bras will cost less than $22 and include plus sizes. Amazon, which in 2017 launched its own line of lingerie called May, sells private label bras at prices mostly between $10 and $22. Victoria's Secret's also facing competition at the higher end of the market, where upstarts powered by social media and e-commerce, including Third Love and Lively, have been pitching themselves as more natural or inclusive alternates. Just a story, by the way, when when we started looking for sponsors for the Stacking Benjamin show. Well, we've always been looking for sponsors, but we were looking for new sponsors. Cheryl, my spouse, kept saying, you got to get Third Love to sponsor you. They'll just send product. Please have Third Love sponsor you. Like she absolutely loves their stuff. She loves their stuff. And so she's like, please, please, please get them to sponsor you. And I'm like, I just can't imagine OG and I talking about Third Love. Like, can you? Stacking Benjamins is supported by, but yeah, not good. So I haven't asked Third Love if they want to sponsor. Third Love, if you want to sponsor the show, though, we're very happy to talk. Back to the piece. Victoria's Secret's also facing competition all over the place. Sales at American Eagle Outfitters lingerie brand Aerie have soared since the teen retailer stopped airbrushing its ads and began featuring models in various shapes. Adore Me, which began as an e-commerce startup but lately has been opening stores near Victoria's Secret locations, said about a third of its revenue comes from plus sizes. Popular bra styles are now often without an underwire or the metal strip. All right, this goes into how bras are created now and how they've changed. I do want to go down to the bottom here. If you want to read this, I'll link to it on my Average Joe Money Twitter feed. But the timing is right, said Mark Triton, Target's chief merchandising officer. Consumer preferences in these categories have evolved. The industry's changed, and we create a lot of momentum in our broader apparel business. Target's new Intimates label appears to match the brand strategy used by Victoria's Secret's parent, L Brands. Target's new lingerie line, Auden, is aimed at women who shop at Victoria's Secret. Its loungewear brand, Saul-Sehy, is directed at shoppers of Pink, L Brand's lingerie label for younger women. The company's also launching another sleepwear brand called Stars Above. Target's marketing and store displays have allowed it to launch more successful clothing brands than Amazon, which has been listing dozens of private label brands online. And it goes on, talking about how Victoria's Secret sales beginning to fall. This is interesting, and the reason I wanted to talk about this is because what's happening here in bras is happening everywhere, and I think it's a great analogy for you and your career, you and whatever you're doing. Things change over time, and as things change in the marketplace, it's always important to change with it. And it's funny to see, we used to think, like in my dad's day, we used to think that having a skill when you're 25 would translate at the time that you're 50. And as an example, I'm a podcaster. Podcasting didn't exist when I was 25. Podcasting was not even a thing. And here I am creating or helping to create 6 or 7 podcasts a week, doing, podcasting is my job. So things change. And as it changes, you have to evolve with it. And Victoria's Secret, back in the day of supermodels and airbrushed ads, dominated that category. And you're seeing the competitors say, well, wait a minute. If we stop airbrushing ads, if we make people look more like people next door, now we have normal people. That is where preferences lie in the bra category, apparently, at this point. So when we take a look at this whole idea of marketing and branding, it changes, but even your expertise. I mean, imagine the consultants at Victoria's Secret who have all this experience. I mean, a lot of people could say, no, we built this whole brand on this whole thing. It's worked this far. It's going to keep working. Things have evolved. The consultant doesn't evolve. You have to evolve. And experience doesn't mean as much as you think it means. I think it's critical. It's absolutely critical that you evolve with the times. And so looking at the bra industry, which is not something that I normally do, I thought this was an absolutely great thing. And here's something else. Look at how Target came up with their strategy here. Their strategy isn't based on some new whiz-bang stuff. They're just lining themselves up exactly where other companies have. Amazon, for one, which hasn't done phenomenal in the space. They're trying to beat Amazon at the same game, but they're lining themselves up directly against Victoria's Secret. It's pretty cool, isn't it? So I think our takeaway here in piece number 2, and this is great for all of us in our career. I think sometimes we think we have to be a maverick, right? I'm a one-man show, do it all myself. No. Collaboration is fantastic. And learning from other brands is fantastic. And taking and incrementally improving is fantastic. Like there's this, I wish I could remember this. I saw this yesterday. There was this great saying I saw from Camus the other day, talking about how really everybody thinks that these huge things that happen in civilization happen because somebody had this huge spark. And actually, Camus preferred to think that it was, Camus a philosopher, for those people that don't know who the hell I'm talking about, that it's incremental improvement. One person on the backs of another, Somebody has an idea, somebody iterates on that idea, somebody else iterates on that idea. Getting there by yourself, not so much. So I think our takeaway here, takeaway number 2, you don't have to reinvent the wheel. Not at all. Do what other people are doing. Do it a little bit better. And you can be very successful. I don't know that Target's going to be successful. But clearly, what I think we are seeing here, and this is pretty definitive, is that we're going to have to see Victoria's Secret change. Victoria's Secret's definitely going to have to change. Let's see what our friends here on Facebook watching us live think about that. We do these podcasts live in front of a Facebook audience, which is why you hear me go, have unnatural pauses. I think half the reason people watch these things partly is to see what kind of train wreck Joe's going to have on this particular day. If you want to hang out with us, by the way, to watch the train wreck in motion, head to facebook.com/iStackBenjamins. And today we actually are recording 2 on the same day. Bobby recorded the one that you heard on Tuesday, and we're recording today's. So April says, never buy Victoria's Secret, never like the fit for any of them. So Victoria's Secret needs to get with the program if they want to compete. Well, there's plenty of, I don't know about the fit, but I will say this, April, clearly with that much competition and so many people trying to eat their lunch, Victoria's Secret is going to have to do something to change the game, especially when they're stagnant. Sales are stagnant or even going down. I think that's the difficulty. Kathy says, I think lots of dollars when I think of bras. They aren't cheap. And also says, versatility for sure is a must. Absolutely. Whenever you're competing at anything, I think you have to be versatile. Just because something worked in the past does not mean it's going to continue to work. So good stuff, guys. And then Kathy says none of the guys piped in on that one. Maybe not so strange. Let's talk a little bit. You know, we're talking about Victoria's Secret maybe investing in change to keep up with Target, who's going after them, or Amazon, who's going after them. But all this talk of investment, I start thinking about your investments. And I think about Emperor Investments, who is our sponsor for this show. What I like about Emperor Investments is that they have refined automated investing. And it's funny because, so when I first heard about Emperor Investments, I thought, another robo-advisor. I can use any of the other robo-advisors. But when you take a look at their website, and I'll give you the link to use, because please use our link when you go there so that they know that you came from us. But if you just go check them out, you'll see how different they are. First of all, when you compare the fees on Emperor Investments versus other fees, we were talking about fees with SoFi today and things for free. When you look at Emperor Investments, it clearly is not free, but when you line it up dollar for dollar, Emperor Investments makes huge sense versus all the competition in the robo market. And then the fact that you own individual equities and what that does for you when it comes to reaching your goal and how it treats you as an individual instead of just another fly in the ointment buying a faceless ETF that we've sold to everybody. I think it's pretty neat. The fact that they can automate that so I don't have to worry about, they have how many clients and they're going to fix my stuff. No, it's all automated based on your goals. So whenever you think about investing, you need to ask yourself about the risk you're taking. And Emperor's investment philosophy prioritizes consistency. And that's why they use individual securities. And they do that without sacrificing returns. And what that means is they only custom build your portfolio out of companies that have a long track record of consistent dividend payments, are likely to continue paying in the future, and can be purchased at a fair price. So you might ask yourself, well, how do they customize it if it's automated? Because everybody reacts differently to financial losses. Emperor begins by getting to know you, but unlike other robo-advisors, they also get to know your goals so that they can further personalize your portfolio across different industries. Emperor Investments is a great way to set your financial goals and get on the path to achieving them through investing. And how about this? Because you listen to or you're watching Money in the Morning, our friends at Emperor are offering you a special deal. How about 6 months free? Here's how you get it. Head to emperorinvest.com/MITM. Don't go to Emperor Investments, by the way. That's a different site. The site's emperorinvest.com/MITM for 6 months free. That's emperorinvest.com/MITM. Good stuff. All right. Let's talk about the big idea today. We always end the show with an idea that kind of combines these two things. So we take SoFi, and how are we going to make something of this? SoFi and bras. If anybody can do it, we can. Right, team? Absolutely. The big idea is this. SoFi has been in lending. And SoFi lately has been marketing a bunch of different products and getting into different parts of the universe. And SoFi surprises me about how quickly they're creating this ecosystem. And as I mentioned earlier, I don't know if that's a good thing or a bad thing, but it is something to watch. And SoFi clearly started out by loaning money to physicians who had lots and lots of debt and refinancing physician student loans. Now they have ETFs. They have high interest savings. They have all kinds of stuff. And on the other side, you've got Victoria's Secret kind of stayed doing the same thing, and Target's evolving. Target boots their old brand to the ground, creates 3 new ones, goes directly after Victoria's Secret. And I think there's a lesson here for us guys. And I think that lesson, and this is today's big deal, is this line that I've liked for a long time, which is that yesterday doesn't have to define tomorrow. If you were in debt yesterday, if you felt bad about yourself, sure, you're going to wake up in debt tomorrow if you had debt yesterday, unless you paid it off. But you don't have to wake up with the same attitude. You don't have to wake up in the same place. You don't have to wake up thinking there's no help for tomorrow. You can change everything. And what's funny is management guru Tom Peters, who I absolutely love, Tom Peters says, how do you change? You change. Now, people might not believe it right away, so you have to change and be consistent over time. People are going to watch your track record. But if things went wrong yesterday, that doesn't mean they have to go wrong tomorrow. Conversely, if things were great yesterday, like they were for Victoria's Secret, that doesn't guarantee tomorrow's going to be great. I love this idea. Yesterday, tomorrow, not the same thing. I think that's our big idea today. Hey, thanks for hanging out with us, everybody on Facebook. Thank you for everybody who listened to this. I'm Joe Saul-Sehy. Go stack some Benjamins. We'll see you next time back here at Money in the Morning.
This show is created by Joe Saul-Sehy, hosted and produced by Bobby Rebell and Joe Saul-Sehy, is engineered by Caden Thompson, and all put together by a pack of well-trained ferrets down here in Joe's mom's basement. You'll find Bobby at the Financial Grown-Up Podcast and Joe at the Stacking Benjamin Show. Go say hi to them there, too. Online, visit us on Twitter at Average Joe Money and at Bobby Rebell, or come join a live recording at our Facebook page. That's facebook.com/iStackBenjamins. I know you already know this too, but Money in the Morning is for entertainment purposes only. You should not act on anything recommended by a bunch of entertainers in a basement or even a Manhattan kitchen without first consulting your financial advisor. And second, dude, have your head examined. Have headlines you'd like us to discuss? Send them to joe@stackingbenjamins.com or put them on our Stacking Benjamins closed Facebook group. This show is a collaboration of Stacking Benjamins LLC and BRK Media LLC. Copyright 2019. All rights reserved. I'm Joe's mom's neighbor Doug, and I reserve the right to always say, we'll see you next time back here on Money in the Morning.